So Jeff, let's take a step back. On July 11, 2019, it's a big announcement. The Nairobi Securities Exchange has finally launched the derivatives exchange. And I want to imagine there are people out there who are wondering, what is a derivatives exchange? Just help us to understand it.
I think I'd like to start with the definition of a derivative before I go into what a derivative exchange is. So, derivative comes from the word derive.
I see.
Derive means getting from something. Getting something from something. Derived from.
Yes.
And so, a derivative is an asset that is derived from another asset. So look at it this way. So we've launched a Safaricom contract.
Yes.
And maybe Safaricom because it's one of our companies and I'm obliged to use it.
Yes.
So the derivatives contract gets its value from Safaricom shares.
Yes.
So anything that happens in Safaricom share has a similar movement on the contract.
The economic benefits.
The economic
risks and benefits
the risks,
are reflected in.
So the movement of those shares are reflected on this derived contract.
Yes.
So if there's a movement upwards or downwards, the value of the contract also changes similarly. Okay.
And the contract is the derivative.
Is a derivative. So these are contracts that get their value from an underlying asset.
Okay.
So it could be a share, it could be a bond, it could be a currency, it could be a commodity. So it's getting its value from an underlying share. That's what a derivative contract means.
I see.
So that's a basic definition.
I see.
And just think about it simply from a layman's perspective. My colleague has said this before. If you look at yogurt, it's a derivative of milk.
Yes.
It gets its characteristics from milk.
From milk.
So I think in a very simple way, it's basically an asset whose character, its formation, is basically a mirror of what another asset is.
I see.
And that's really what it is.
It's a mirror asset of another asset.
Of another asset.
Of another asset.
Correct.
And I'm just wondering very wildly, why would I buy a contract instead of buying Safaricom directly?
Precisely.
Yeah.
There are many reasons.
Yes.
For instance, if you wanted to buy a share like Safaricom, or let's say a higher valued share like BAT, for instance, 100 shares of BAT times the cost of BAT today is a bit expensive for investors to afford. But if you have a contract, assuming BAT will go for 200, and you're buying 100 shares, that's going to cost you 20,000. All right. If you have a contract, you can still buy the similar value of BAT, which is expressed in form of a contract.
Yes.
But for 10% of the contract price.
Okay.
Yeah. What am I looking for? I'm looking at just getting the value movement of the share.
I see.
As opposed to the actual cost of that share.
Yes.
So the cost, it helps from somebody who would like to get to a more expensive stock, can do this through a contract, as opposed to going through the spot market.
I see.
All right? That's one of the good reasons.
Yes.
The other reason is that I want to, and this is for investors who invest in the market, for instance, pension funds.
Yes.
At the moment, I don't have any protection on my on the movement of my shares.
Yes.
If they go up, I make money.
Yes.
If they go down, I make losses.
Yes.
What can protect me from this volatility?
I see.
I buy a contract that is matching what I'm holding.
I see.
So if the value of the spot market goes down, I have a sell contract whose value appreciates as the market goes down. So I'm protected. I'm actually gaining on the opposite side.
I see.
Which wasn't there initially.
I see.
So that's another very, very valid reason.
I see. So
two
reasons.
Two key reasons to buy.
Yes.
And also to trade.
And to trade.
Again, there are monies that you make.
Yes.
You know, I can make my money on the shares.
Yes.
But I can also make money on the spot market.
Absolutely.
If the shares are not available, I go and buy a contract that has got exposure to the share.
To the share.
And that's the opportunity.
Absolutely.
So these are the various opportunities that I think, from a very basic perspective, begin your thinking towards why I need to buy this contract.
Yes.
But there are many other reasons.
Yes.
opportunity to buy and sell. What we use in our market called arbitrage. Arbitrage is just identifying an opportunity between two options.
Yes.
You know, one option is showing me if I trade this and say buy this, I can make a benefit.
Yes.
So I think that those are the very complex.
I see. So two big reasons.
Yes.
Access liquidity. And risk management. And liquidity is, you're saying, okay, BAT may not be easily available to me, but I can actually access it through a contract that mirrors the BAT.
Correct.
Risk management means I may have my Safaricom shares and I don't want to sell them because the market is coming down.
Correct.
And I just buy a contract to counter that effect on my portfolio.
That's correct.
So then how would you define a derivatives exchange?
So the derivatives exchange now is the market where these contracts are traded. Are bought and sold.
I see.
So the structure of the market is such that at the very top of the market, we have what you call a clearinghouse. So this is where the contracts actually exchange value.
I see.
From a technical perspective, we call them novation.
Yes.
Which essentially means they are like the buyer to every seller, and the seller to every buyer.
Yes.
So they guarantee the trade happening.
Yes.
Then you have the clearing members, which are basically banks, who are the ones who hold margins or hold the contract. The money is paid for the contracts.
Yes.
And then below them we have the trading members, who are the people who interact with the clients.
Yes.
So you buy your contract to a trading member, it transmits the money to the clearinghouse transmits money to the clearing member, the clearing members, which are banks, transmit the money to the clearinghouse.
Yes.
And depending on whether you're making money or losing money, the movement of that liquidity happens on a daily basis. Through that structure.
I see.
So the exchange is where contracts will be traded.
Yes.
We have other contracts which we'll bring in the future, like so we've got futures, we've got options that will come in the future.
Yeah.
And one day we also trade on commodity derivatives.
Yeah.
So this is the market, just like a normal exchange.
I see.
So all contracts for derivatives are traded on the derivatives exchange.
I see. Okay. So a derivatives exchange is where we buyers and sellers of contracts meet.
Correct.
And exchange.
And exchange value.
Correct. Exchange value. Yes. Interesting.
The good thing about it, the value exchange is every day. So you're in the money on a day, or you're out of the money on a day.
I see.
Because the margins are moving on a daily basis. It's quite different from a stock, where you only get your actual real value by selling the share.
Exactly.
Yeah. Here the value comes to you as you hold the contract on a daily basis.
And you bring in an interesting perspective. It's a contract, which means it has an expiry date.
It has an expiry date.
So every day you're comparing the values, and you're seeing who owes the other.
Correct.
Until the day of the
expiry, then everybody is paid off.
You close the position. The one who owes the other, pays the other.
Absolutely. What happens now at the end of that expiry? The exchange will then settle everybody's position. So if you have the money, your clearing member will receive value and transmit it downwards. If you have lost money, whatever remains is then transmitted to you downwards.
I see.
To the clearing member. So we'll ensure settlement happens on closure date.
So that closure date, the expiry date, one counterparty will be in the money,
and one
counterparty will be out of the money.
Yes.
There you go. That's what you call a derivatives exchange.
Correct.
Thank you for watching. Stay tuned in as we continue demystifying the derivatives exchange.